All right, let's dive right into this explainer. Today, we're tearing down the numbers behind Blue Owl Capital Corporation, that's ticker symbol OBDC, to uncover if this stock is the ultimate income dream or if it's actually a financial nightmare in disguise.
Just think about this for a second. In a world where really safe bonds are paying you, maybe 4%, OBDC is dangling a staggering 11.7% dividend yield. I mean, that is nearly 12 cents on every single dollar you invest, which is an absolute magnet for income-seeking portfolios.
Now, that sounds absolutely incredible, right? Well, until you look under the hood and realize a few harsh realities. In their last quarter, they actually lost money on a standard accounting or GAAP basis. Plus, they just cut their dividend by a painful 16%, and they are facing a massive earnings report happening literally today. So yeah, the stakes could not be higher.
So, to really understand what's at stake here, we first need to know what this company actually does. OBDC is what we call a business development company, or a BDC. Basically, they act as a vital lender to the middle market. They're managing capital for over 230 companies spread across 30 different industries. Think of them as the financial engine for businesses like healthcare providers, manufacturers, and tech firms, the kind of companies that just don't easily fit into the traditional bank loan box.
And this right here brilliantly illustrates the foundation of their whole operation. A massive 78% of their portfolio is sitting in senior secured floating rate loans. For those of you familiar with credit markets, you know this is the safest tier of corporate debt. If a borrower defaults, OBDC is literally first in line to get paid back. Plus, that floating rate nature gives them some built-in protection against interest rate fluctuations. But here's where things get super interesting. When you stack up that compelling surface-level valuation against the underlying financial reality, the tension is it's incredibly clear. On paper, you're buying $1 of assets for just 78 cents, accompanied by that huge yield. But look at the harsh reality side. A GAAP loss, a slash dividend, and a payout ratio that is flashing bright red.
Which brings us to Section 1, the hidden red flags.
Okay, we need to talk about some seriously alarming metrics here. We are looking at a 110% earnings collapse year over year, which resulted in a GAAP loss of 5 cents per share. That loss is exactly what triggered a 16% dividend cut. And look, a dividend cut isn't just a bummer for your income stream, it actually serves as management's own direct admission that conditions are deteriorating. Furthermore, their asset base, the very portfolio that generates their income, contracted by a staggering $1 billion in a single quarter, simply because repayments and sales outpaced new investments. And to top it all off, when you take a rigorous look at intrinsic value, models like the Guru-focused GF value suggest the stock is actually 19% overvalued today.
Now, legendary investor Peter Lynch famously looked for insider buying as a major signal of confidence. Well, here, insider ownership is a microscopic 0.27%. That means the people running this $5.5 billion company have virtually zero skin in the game. In fact, over the past 3 months, insiders bought just $125,000 worth of stock, which is absolute pocket change at this scale. When management's wealth isn't tied to the stock's performance alongside everyday shareholders, it's a significant governance concern.
And shifting over to Warren Buffett's philosophy, we know he strictly avoids companies that need high leverage to generate returns. Here, total debt is sitting at $8.45 billion, creating a 118% debt-to-equity ratio. Their interest coverage is just 2.3 times. In a severe credit downturn, this highly leveraged position could easily destroy equity, amplifying any losses hidden inside that underlying loan portfolio.
But wait, let's look at the other side of the coin. In Section 2, the compelling green flags. Because, to be fair, there is a very real bull case here that we cannot ignore. I mean, you are essentially buying $1 of loan assets for just 78 cents thanks to that deep 22% discount to net asset value. And even after the cut, that 11.7% yield still absolutely towers over the broader market. Let's not forget the cash engine either. Trailing operating cash flow sits at an impressive $2.67 billion, driving $470 million in free cash flow. Plus, OBDC is backed by the massive Blue Owl alternative asset platform, which gives them a world-class underwriting and deal sourcing engine. Honestly, it's no wonder the consensus analyst rating remains a solid buy with a $13 price target.
And when we look at their fundamental efficiency, it turns out OBDC is actually still creating modest value. Their return on invested capital, which is the actual cash return they generate on their investments, sits at 8.37%, cleanly exceeding their 7.18% cost of capital, or WACC. The spread might be a little thin, sure, but it is firmly positive. It shows us the core economic engine is actually still working.
All right, let's put all this conflicting data to the ultimate test in Section 3, the Guru Gauntlet. Let's run a complete stock analysis using the frameworks of some of the best to ever do it, starting with the Benjamin Graham lens. If we use his strict intrinsic value formula, the square root of 22.5 times EPS times book value, he actually sees a borderline margin of safety here. That's mainly thanks to the 0.78 price-to-book ratio, though he'd definitely note the PE is a bit elevated. Next, the Peter Lynch lens. Lynch would likely categorize this as a struggling cyclical play. Looking at a PEG ratio near 2.0 with shrinking revenues, his verdict is a clear avoid. Then we have the Warren Buffett lens. For Buffett, the lack of a clear economic moat, a return on equity sitting under 5%, and that dangerous leverage we talked about earlier make this a hard pass. Finally, if we build out a base case discounted cash flow or DCF valuation, factoring in their shrinking free cash flows, it yields a fair value well below current trading prices. So the synthesis here. When we blend the insights from Buffett, Lynch, Graham, and the DCF model, the gurus are advising extreme caution.
Which brings us to our final part, Section 4, Verdict and Earnings Catalyst.
And guess what? We are going to get our answer basically immediately, because OBDC reports their Q2 earnings today, right after the market closes. This makes our analysis a ticking clock scenario. This earnings report is going to be the massive catalyst that either totally validates those green flags or completely confirms the red ones.
So if you're watching this right now, you need a playbook. Here are 5 specific metrics you need to monitor in the earnings release tonight. First, watch the net investment income trajectory. Did it actually recover from the 31 cents we saw last quarter? Second, check the stability of the $14.41 net asset value. Did the portfolio bleed even more value? Third, see if that $1 billion portfolio contraction somehow reversed. Fourth, listen really closely to management's guidance for the future. And fifth, ultimately gauge the safety of that new 31-cent dividend. We need to see if the business stabilizes or if further cuts are coming down the pipe.
So I want you to really think about this risk-reward balance. This is a complex asset, demanding careful thought. Is the deep discount and double-digit payout worth the structural risks? Look at the facts we've laid out today, weigh the green flags against the red, and let me know your strategy as we head into this pivotal earnings release. Thanks so much for joining me on this explainer, and stay sharp out there.